Hi, I'm Kylie Mathieu, and welcome to Wealthy Millionaire. Today we're going to talk about investment portfolios and how to build a good one. But first, disclaimer, I'm not a lawyer, I'm not an accountant, and always be sure to check with your financial advisor before making any decisions on your investments. An investment portfolio is one of the terms you'll come across as you venture into the investment industry. While building a good investment portfolio, it might seem intimidating to start, but the good news is that you don't necessarily need to be wealthy or even have many years of experience as an investor to succeed. Today we're going to talk through the basics of building a solid investment portfolio. So what is an investment portfolio? It's a collection of various financial investments, including stocks, bonds, cash, commodities, and cash equivalents. While stocks and bonds are typically considered the building blocks of an investment portfolio, it's possible to create one using different types of assets. Investors seek to build a well-managed and diversified portfolio to distribute their risks, manage risks, and increase returns for their investments. For example, you could own a stock portfolio and invest 20% of your portfolio into different stock categories, and you would have a diversified portfolio. While there are certain rules to portfolio management, different investors approach their portfolios in different ways depending on factors such as their age, tolerance for risk, and investment goals. Such approaches lead to different types of portfolios. Different types of investors will approach their portfolios in different ways, resulting in a variety of investment portfolios. The approach you pick will depend on your personality, investment style, and risk appetite. Let's take a look at some of the portfolio types. An aggressive portfolio attempts to maximize returns by taking a higher degree of risk, typically emphasizing capital appreciation rather than income or safety of a principal. Aggressive investors typically go for high risk, high reward asset classes such as equities and commodities. An aggressive portfolio requires active management as it comes with higher volatility and may need frequent adjustments. Most aggressive investors go for fast growth, for instance, growth stocks. Aggressive investors must have sharp risk management techniques to minimize their losses and increase their returns. Then we have a defensive portfolio. In aggressive portfolio management, the investor relies on strategies such as an asset allocation and asset selection. In a defensive portfolio, the investor looks for securities with specific characteristics such as reduced volatility. And to build a defensive portfolio, you need to select stocks that historically have a lower level of volatility in down markets. Defensive stocks are a good candidate for this portfolio as they tend to do well in good or bad economic times. Then we have income portfolios. So these focus on investing in assets that generate income for the investor through dividends or other distributions. The income portfolio includes some defensive stocks as they tend to pay dividends and other high-yield stocks. Examples of investments that work well in an income portfolio include real estate investment trusts and master limited partnerships. These investment returns are majority of their profits to shareholders. However, income-generating investments such as REITs move with the economic climate, often taking a beating during economic downturns. Then we have a speculative portfolio, often involves taking more risk. In speculative investment, the investor seeks to profit from price fluctuations as the market changes. Angel investors and venture capitalists are examples of a speculative investor, as they typically invest in high-risk investments with an incredible potential upside. Although speculative investments are high risk, they can be very rewarding if the investor's speculation works to their advantage. With that said, experts recommend that you invest a maximum of 10% of your portfolio into these assets. Then we have a hybrid portfolio, which is highly flexible, and it includes a mix of different stocks, bonds, and other securities in different proportions. Now that you know the common types of investment portfolios, it's time to build one for yourself. Building an investment is a process and looks different for every investor. So let's take a look at some of the general rules and steps to lead you to a good portfolio. So one of the first things you need to look at is your risk tolerance. So this refers to the level of uncertainty that an investor can handle in their financial planning and investments. An investor's risk tolerance depends on a variety of factors, including age, personality, net worth, disposable income. Understanding your risk tolerance is critical to avoiding panic-driven mistakes and selling too soon or emotional trading. Knowing your risk tolerance also helps you choose the right investments that match your personality and risk appetite. Your ability to take risks is taking into consideration your income, liabilities, commitment, debt, and age may affect your ability to take risks as well. In general, younger individuals with fewer liabilities can take more risks. Your need to take a risk, what are your financial goals and the returns you're expecting from your investments with the influence you need to take risks. And also your time horizon. Shorter investment horizons limit your abilities to take risks. After considering these factors, you may fit into one of these risk profiles, an aggressive, moderate, or conservative. Whether you're an aggressive or conservative investor, diversification is key to a solid investment portfolio. Diversification safeguards your investment from undesirable market conditions while providing optimal returns. The goal of diversification is to distribute your risk and minimize as much as possible so that no single investment has a large effect on your overall portfolio or returns. So when choosing an investment account, you need one that's going to help you build your investment portfolio, and you should choose one that helps you towards your goals. For example, if you're investing for retirement, a retirement account such as an IRA account is better suited to your goals. A stock brokerage account, on the other hand, is ideal if you want to trade stocks or other securities. Asset allocation is also an important part of building a solid investment portfolio. Asset allocation refers to the percentage of each asset you hold in your portfolio. So choosing the right assets and allocating them to your portfolio depends on factors like expectations, investment time horizon, and risk profile. So some of the assets you may include in your portfolio are stocks, bonds, and mutual funds. Let's take a look. Stocks are a small bit of ownership inside a company. Investors buy stocks that they believe will go up in value over time. The risk in a stock is that it might not go up at all or may even lose value. Then we have bonds, which are loans to companies or the government that an investor will get back over time with interest. They are considered to be a safer investment than stocks, but generally have lower returns. Since you will know that amount of interest that you're going to be receiving, it is great for balancing out your portfolio from riskier investments. Then with a mutual fund, you have multiple to choose from. But the advantage with mutual funds is that they allow you to add instant diversification to your portfolio. Mutual funds are a basket filled with investments such as stocks and bonds at the same time. To a degree, there is some risk, but generally less risky than an individual stock. There's also index funds and ETFs, which try to match the performance of a relative market index, such as S&P 500. These don't require an active fund manager to choose the investments, and they also tend to have a lower fee than actively managed funds. The main difference between ETFs and index funds is that ETFs can be actively traded throughout the trading day, like individual stocks, while index funds can only be bought and sold for the price set at the end of the trading day. Another form of investing that you can consider is impact investing, which is an investment style where you choose based on values. For example, some environmental funds only include companies with low carbon emissions, and others include companies with more women in leadership positions. If you notice your investment goals aren't on target or no longer reflect your risk tolerance, you could end up with more risk than you initially planned to take on. So some ways to rebalance and mitigate your risk, you can sell high and buy low. Meaning, if you have stocks that have outperformed, you can sell the profits and reinvest into bonds for a more balanced portfolio. This is the fastest way to bring your portfolio back into target. Just keep in mind that selling stock assets for profit can have tax implications, so always make sure to consult your accountant. If you're building your portfolio from scratch, look for model portfolios that show you how other investors with different risk tolerance actually construct their portfolios. Evaluate and rebalance your investment portfolio as needed. Your investment portfolio is actually never set in stone, and it evolves as you gain more experience with changing market conditions. Evaluating your portfolio on the regular, experts actually recommend between 6 and 12 months. It allows you to know when you're taking too much risk that you can handle or leaving opportunities on the table. When you track your investment portfolio regularly, you can correct your course in good time, and it allows you to remain on track to achieving your investment goals. Whether or not you are a beginner in investing, building and maintaining a good portfolio is the key to meeting your financial goals. A good investment portfolio means different things to different people, but it should align with your risk profile and your investment horizon and your overall financial goals. I hope you enjoyed that session. Thank you for joining Wealthy Millionaire. I'm Kylie Matu.